So we are live now, sir, and I welcome all the participants, and I welcome once again CA and Dr. Rakesh Gupta ji once again on our platform. And today we are honored that sir is again with us, and our today's topic is on the tax audit. Sir will enlighten us from his experience on the tax audit, and topic is to tax audit and critical issues of tax audit, which will be taken care by CA and Dr. Rakesh Gupta ji, who is ex-IPT member. And although sir का introduction की everybody is aware about Rakesh Gupta ji, and in the field of the direct tax, सर का इतना रुतबा है कि जैसे सर का इंट्रोडक्शन देने के लिए भी है कि सूरज को दिए दिखाने वाली बात है. So, but still, I will give you the brief introduction of Rakesh Gupta ji as a protocol, and then we will start our today's session. So, just give me 1 second. Let me start with the introduction of Rakesh Gupta ji. So, Rakesh Gupta ji is a fellow member of ICI and ICSI. He is also an associate member of ICI CMA. He is a gold medalist in LLB and has done PhD LLB and examination and holds master degree in law management. He has also done PhD in corporate governance and business ethics. He is practiced as a chartered accountant from 1984 to 2000. Before he was appointed as member of Income Tax Appellate Tribunal (ITAT) in year 2000, when he was 36 years of age. At very young age, he was appointed as ITAT member, and Sir has resigned from the ITAT and resumed his practice as an advocate, and right now is presenting income tax cases before various high courts, Supreme Courts of India as well. And Sir is having more than decades of experience in the field of the taxes and business advisory matter. Sir represents UP government in Supreme Court of India as well as a special council member as well. And Sir is a eminent speaker and addressed several seminars and workshops on the legal and practical topics related to the income tax, and has co-authored a detailed complementary on law relating to the search and seizure as well. He has been contributing articles on various publications, magazines, writing columns in newspaper, and making appearance on various television channels as well. Sir has traveled abroad as well for in recent past, and has attended an invitation, a conference on international taxation for updation of UN model tax convenient at United Nations headquarters, New York as well. So this was the brief introduction of Dr. Rakesh Gupta ji. Now we have more than 100 members has already joined. So let's start our today's session. And I will request now Sir to start his deliberation.
Thank you, Deepak.
Thank you, sir.
A very galaxy of my professional friends and colleagues who are logged on YouTube to hear me on the topic of tax audit. But the way I tend to discuss tax audit is somewhat unconventional. I am not there to discuss about the audit steps or the modus of audit which is to be followed, but from a different perspective, standpoint, and approach, which I will unleash in some times to come. Now, tax audit, of course, when the word audit is there, there have to be books of accounts. Therefore, the requirement of keeping and maintaining books of account assumes importance, and therefore there are somewhat confusing state of mind as to whether in such a case there is, if at all, need for maintaining books of account. Forget about the audit. Therefore, today I will give my deliberations on issue based deliberations. I will rake up and raise issues, and then I will try to answer with logic, rationale, philosophy, jurisprudence. So, very first question: Since we all are professionals, and therefore I would pick up my first issue relating to the professionals only. We all know we have got prescribed professions as mentioned under section 44AA, and certain professions which are not so prescribed and they are notified professions. And all these professionals, whether prescribed professionals or the notified professionals, now they have been given a privilege in terms of section 44ADA. And the section says that if the gross receipts from the professionals carrying on the professions as are referred under section 44AA may declare their income if their gross receipts from the profession are less than 50 lakhs of rupees at 50% or such higher amount as may be claimed by them to have earned higher. And in that situation, such professionals are not required to maintain books of account, which is though not said in very many words under section 44 ADA, but the very fact that subsection 4 of section 44 ADA says and provides that in a case where such professionals do not disclose income under subsection 1 of section 44 ADA in any year, meaning thereby that minimum 50% of the gross receipts, then such professionals are required to maintain books of account and get them audited under section 44 AB. So this requirement of maintenance of books of accounts and getting them audited, they are the two requirements which is evident from the plain reading of subsection 4. It is quite interesting to note that the main section, that is section 44AA, and the rule made thereunder, that is rule 6F, it requires every professional to maintain the prescribed books of account as mentioned under sub rule 2 of rule 6F. And in case you are a doctor, then additional 2 records as per sub rule 3 of rule 6F. If the gross professional receipts in preceding 3 years, in all the 3 years, exceed rupees 1,50,000. Therefore, as per the mandate of the main section which requires a professional to maintain books of account, the moment his gross receipts in preceding 3 years exceed in all the 3 years by more than 1,50,000 rupees in each year, then he is required to maintain books of account. And as per the plain reading of section 44 ADA, there is no respite or relief or exclusion or exceptions in case of professional. Whereas section 44 ADA, subsection 4 gives this interpretation that in case your receipts are less than 50 lakhs of rupees, maybe much more than that 1,50,000 rupees limit which is there under section 44AA or read with rule 6F. And if you declare professional income at least 50% from such gross receipts, then you are not required to maintain book of account. So section 44 ADA and section 44 AA, these sections do not see each other or do not see eye and eye to each other, and they are at variance. They are in conflict with each other. But subsection 4 of section 44 ADA will have to be interpreted in such a manner, read with section 44 ADA 1, that till the professional receipts are not more than 50 lakhs of rupees, you as a professional return at least 50% of the receipts as the professional income, then you are not required to maintain books of account, even if you are required to maintain books of accounts as per the plain mandate of section 44 AA subsection 1, read with rule 6F sub rule 1. So this conflict will have to be reconciled and resolved in this manner. Now the next issue which comes is whether this section 44 ADA is mandatory for a professional having gross receipts less than 50 lakhs to follow, or in case if he does not want to follow, or if he does not follow, then what obligations are cast on him. So subsection 1 and subsection 4 of section 44 ADA, if read in combination, would unequivocally require or give mandate for a professional either to declare his or her income as per the mandate of subsection 1 of section 44 ADA, that is minimum 50%, or such higher amount as claimed by that SSE, and may not maintain books of account. And since he may not maintain books of account, therefore there will not be any need for him to get his accounts audited. But then if professional income is less than 50%, then in that situation he is required not only to maintain the books of account, but then he is required to get them tax audited under section 44 AB, provided his income, total income, is above the basic threshold limit. So this is there under section 44 ADA 4, and there is a corresponding provision under section 44 AB also. Under section 44 capital AB clause small d. So for the purpose of audit, there is a specific provision for the professionals which are covered under section 44 ADA or which are not covered under section 44 ADA. But for the purpose of keeping and maintaining books of account, section 44 ADA and section 44 AA, they are in conflict with each other. Now proceeding further. So as I just concluded in terms of section 44 ADA, that it is almost mandatory in case one does not want to maintain books of account. But whether such kind of a mandate can be read from the provisions of section 44 AD, because section 44 AD subsection 1 is almost identically worded as section 44 AD, and subsection 1 of section 44 AD says that in case of an eligible SSE carrying on eligible business, profit or gain would be deemed to be the income from business equal to 8% of the turnover of the gross receipts or such higher amount as may be claimed by the SSE. So it gives an impression, though as I would proceed, then I would explain that that is not the law. That gives an impression as if you are carrying on any business which is eligible business having turnover less than 2 crores of rupees, as if you are mandatorily required to maintain or to declare your income under section 44 AD subsection 1. But in the absence of an identical provision under section 44 AD on the lines of section 44 AD subsection 4, now this mandatory character of section 44 AD you would find does not exist. Meaning thereby that unless in any year you have claimed the benefit of subsection 1 of section 44 AD, till that time, even if you are an eligible SSE carrying on eligible business, but then if you choose to declare your profits as per the books of accounts maintained by you, declaring any amount of profit, then 44 AD subsection 1 8% minimum, that will not be thrust upon you, that will not be made mandatory for you. Where would that be mandatory? I will come. Therefore, let us understand first of all this thing, that 44 AD subsection 1 benefit or privilege to declare your return or declare your income at 8% of your turnover or receipt is not mandatory unless and up to that year in which you yourself have claimed the benefit of subsection 1 of section 4480. Suppose you set up your business in this year. Your turnover is say 1 crore 50 lakhs. You maintain books of account, you get them audited under section 44AB because your turnover is more than a crore of rupees. Or even if your turnover is less than 1 crore of rupees, you need not to get them audited under section 44AB because the threshold is 1 crore. And on that basis, whatever income is there, whether in percentage terms it comes 6%, 4%, 5%, even loss, you have not to get them, or you have not, you will not be treated to have been hit by section 4480. But if in any year you yourself have claimed the benefit of subsection 1 of section 4480, then as per section 4480 subsection 4, then it is almost incumbent and obligatory on you to return your income in next 5 years in terms of subsection 1 of section 44 AD. And if in any of these years you declare your profits not in accordance with subsection 1 of section 44 AD, then in that year the first disability is that next 5 years you cannot opt for 44 AD subsection 1. Number 1. Number 2, subsection 5 of section 44 AD says that in that situation you will have to maintain books of account irrespective of your turnover. And then if your total income is above the basic threshold limit, then you have to get them audited also. And the corresponding provision has been made under section 44 AA for maintaining books of account. In such a situation, if you are hit by subsection 4 of section 44 AD, and under section 44 AB also, this mandate has been given in the form of clause small e. Now it takes us to, therefore it takes us to that interpretation that 44 AD1 is not mandatory until in any year you yourself have opted for 44 AD1. Then in next 5 years it is obligatory on you to adopt 44 AD1. And if for any reason you are not in position to declare your profits in accordance with subsection on section 44 AD, and next 5 years you would not be able to claim it. And then you are required to maintain books of account, get them audited if your total income is above the basic threshold. So 44 AD in that sense is not mandatory. It will assume the mandatory character once you yourself have opted 44 AD subsection 1 in any of the year. So to that extent, 44 AD and 44 ADA in its mandatory character varies. Now under subsection 4 of section 44 AD, if any of the 5 succeeding years, succeeding to the year in which you yourself have opted for 44 AD1, you declare profit not in accordance with subsection 1, meaning thereby that you being eligible SSE, carrying on eligible business, did not claim it under 44 AD1 only then. Meaning thereby that if in any one of those 5 years your turnover exceeded the limit of 2 crores, and because of which you could no longer remain eligible business, or you could not be carrying on eligible business, because eligible business means the business, the turnover of which is less than 2 crores of rupees. So in that situation, that year, or that perforced inability to opt for 44 AD1 would not come in your way, And while computing 5 years, such years will be ignored. That is what my respectful interpretation is. But then, despite you being eligible SSE, carrying on eligible business, having turnover less than 2 crores of rupees, if any of those succeeding 5 years you do not declare profits in accordance with subsection or section 44, then there is a problem. So now you may have understood that under 44 ADA, where you have to get your accounts audited, under section 44 AD, subsection 4, when you are hit by it, then you have to get your books of accounts audited. Now, 44 AD and 44 AB both use the expressions turnover or gross receipts. 44 AB also uses the expression sales. And the determination of the quantum of turnover, gross receipts, or sales is essential for us to see whether the requirement of tax audit is there or not. Number one, because various threshold limits have been given under section 44 AB, that in case your turnover, gross receipts, or sales exceed this limit, then you have to get compulsorily your accounts audited. Under section 44 AD, the turnover or gross receipts should not be more than 2 crores of rupees. Only then you can be said to be carrying on eligible business. That is one of the criteria. And if you are carrying on eligible business, then the quantum of your income, 8% of turnover or gross receipts. Therefore, the determination of turnover or gross receipts is essential for section 44 AB and for section 44 AD equally. For the purpose of section 44 AB, since this provision is very old, almost now there on the statute for almost 35 years, our institute's guidance note benefit is available to us, coupled with lots of judicial decisions. And I am conscious that the institute's guidance note says in the matter of the inclusion of the statutory duties, says that if you are following exclusive method, then you need not to aggregate such tax duty or cess along with the turnover in order to see the limit of turnover. And I have been told that the institute's guidance note still holds that view. But section 43 CA has come later on. Section 145 capital A, now that has also been brought on the statute but much later. Therefore, for the purpose of reckoning the quantum of turnover, now whether we would go, we should go, we ought to go by the old understanding, appreciation of the legal position, or whether these sections which I have just mentioned, section 43 CA or the import and impact of section 145 capital A, have also to be kept in mind, is a question which requires some amount of deliberations and discussion. Section 44 AB prescribes us the threshold limit of turnover, sales, gross receipts, and the moment a person carrying on business achieves that threshold, then is required to get his accounts audited, obtain the audit report, furnish it now as per the amendment of Finance Act 2020, at least a month before the due date of filing of return under section 139(1). Section 145 capital A says that for the purpose of computing income under the head profit and gains of business or profession. So, having regard to the language which has been used under section 145 capital A, one may tend to take a view that the definition of turnover to include tax, duty, or cess in terms of section 145 capital A may not be applicable when it comes to the determination of turnover sales under section 44AB. That may be one view, and that view may also be upheld by the authorities. 43CA, that if you are a person carrying on the business of real estate, holding land or building as a stock in trade, then on the sale of that land or building, which is a stock in trade, any consideration received or accruing, if it is less than the stamp duty value, then stamp duty value shall be deemed to be the full value of consideration. Now, whether in the light of these expressions, whether the full value of considerations of what? Full value of considerations of sales, turnover. But one view of interpretation is that when we have to see section 44AB, then we have not to give any cognizance as to the notional impact on the turnover of the gross receipts. So for the purpose of section 44AB, the meaning of turnover to include tax, duty, or cess under section 145A, or to include notional considerations received or accruing because of the legal fiction under section 43CA may make some sense, though litigation cannot be ruled out. The aggressive posturing which the department has undertaken, even in one of the frequently asked questions, the board has said that for the purpose of turnover, for the purpose of section 44AD, of course, now we intend to include tax, duty, or cess irrespective of your method of accounting, and that is also settled law, that your income tax liability is not hostage to the manner and mode of you making entries in a books of account. Therefore, for the purpose of section 44AB, in order to determine the quantum of turnover, now we may very well go in for the interpretations adopted by the institute. But for the purpose of determining the quantum of turnover for the purpose of section 44AD, which is nothing but is for the purpose of computing income under that business, whether both these sections, section 145 capital A and section 43CA, can be ignored. Now that is something which is fraught with lot of controversy. Though for the purpose of section 44AB, now you can very well advance your reliance on the institute's guidance note as a basis for you to entertain a bona fide belief for excluding these tax, duty, or cess from the purview of turnover or sales, and that entertaining that bona fide belief based upon the institute's guidance note can act as a defense mechanism for you to avoid the levy of penalty on the ground that there was a reasonable cause for you to not getting the accounts audited because of you taking this kind of interpretations, that too based on the recommendations and the guidance note of the institute. That may very well be possible. But for the purpose of section 44AD, now this kind of a bona fide belief may not work. Therefore, the amplification, the meaning of the term turnover now will have to be seen, at least for the purpose of section 44AD, in the light of section 145 capital A at least. For the purpose of section 43CA also, for this notional increase in the sales on account of the fiction of section 43CA, you can make out a case that that notional difference would not constitute part of turnover. But in that situation, the department may say that, okay, We will not take it as a part of a turnover, but then the entire difference we'll add it separately, because section 44 AD starts, notwithstanding anything contrary contained in section 28 to 43C, and therefore section 44 AD is beside section 43CA, and therefore that kind of a risk now will keep on staring at your face. That you'll have to bear in mind. The next issue, now 44 AB subclause A now has been added with a proviso by the Finance Act 2020, according to which now the threshold of 1 crore is required to be read at 5 crores if the aggregate of receipts in cash does not exceed 5% of the aggregate receipts, and aggregate payments in cash does not exceed 5% of the aggregate payments. Then in that situation, proviso which has been inserted by the Finance Act 2020 with effect from 1/4/2020 says that this limit of 1 crore for a person carrying on business now would have to be read as if the threshold is 5 crores of rupees. Therefore, it is very important for us to appreciate and assume as to what is the meaning of aggregate receipts and aggregate payments. Now, first of all, we must bear in our mind that aggregate receipts and aggregate payments they are without any qualifications. Therefore, these receipts and payments may be on capital accounts also, may not necessarily be on revenue accounts alone. Therefore, if receipts have been made on account of any loan or the repayment of loan received by me back, or the receipt of capital. Now, aggregate receipts, when the legislature has used the expressions in such omnibus and generalized manner, with no distinctions having been brought and made by the legislature, therefore, to read any artificial limitations on the meaning of these expressions now is not permissible in law. And therefore, when if somebody says that we can ignore the receipt in cash on account of capital from the partner in case of the partnership firm, or the withdrawal by a partner from the partnership firm in cash, now that will not form part of the cash receipts and cash payments, then I would say that such kind of interpretation may ultimately be held as tenable, but then this is quite aggressive interpretation. This is aggressive, and whether it is called for or not, that has also to be seen from the expediency point of view, because if you take this kind of interpretations, that too on the premise that the partnership firm and the partners are one and the same entities under the civil law, therefore the interstate transactions between the partnership firm and the partners are as if money is changing one hand from one hand to another in the hands of the same entity, then I would say that such kind of aggressive interpretation is fraught with lots of possible risk of litigations, because under the Income Tax Act, the partnership firm and the partner are considered two separate, distinct and independent entities. Yes, but then if a client, having taken that kind of a stand, approaches us, then obviously in that situations, then we would argue on these lines that the partnership firm and the partners are one and the same entity under the civil law, and therefore these receipts from the partner or the payments to the partner should neither form part of the receipts nor should form part of the payment. But then by taking that kind of aggressive interpretation, I am doing no good for anybody. My client would say, okay, now if you exclude these receipts and payments from the cash, then I need not to get my books of accounts audited because the threshold becomes 5 crores of rupees. On the other hand, the department may be on the hot pursuits after such SSCs that you have not got your accounts audited since your payments in cash or receipts in cash have exceeded 5% after taking into account the receipts and payments from or to the partners. And therefore, why should the penalty be not imposed under section 271 capital B equal to 1,50,000 rupees or 0.5% of the turnover, whichever is less. So by taking that kind of an aggressive interpretations, I may not end up in doing good to either myself as a practicing chartered accountant or to my client. Therefore, in such a situation, a reasonable interpretation may be taken. Rather, whenever such kind of a dilemma is there, whether like even in the matter of TDS, I mean the theory of conservatism, I mean that should act as a guidepost for us. So in such a situation, there is all the more reason for us to take the theory of conservatism, because professional opportunity one side, and then the ignominy of the SSC undergoing the rigmarole of the litigation, I mean that may also be kept in mind. Yes, of course, if you are a proprietor withdrawing from the bank account, depositing cash in the bank account, will obviously not form part of either receipts or payments. But then if you are borrowing in cash, though somebody may say, sir, you cannot borrow because of the restriction under section 269 SS. No, there may not be absolute restriction in section 269 SS. The restriction is only to this extent that if one takes, then one may be prone to be penalized under section 271 capital D. There is no absolute bar. So such receipts or such repayments, any buying, whether of revenue account or on capital account, now they all will have to be seen in order to see the cash receipts and cash payments, whether exceeding 5% of the total cash receipts and total cash payments, the total receipts and total payments. So we have to strike, or we have to ensure that at this stage, later on, I'll say where the aggressive posturing has to be resorted to, can be resorted to, but at the threshold of seeing whether one has to go in for audit or not, at this stage, for the expediency sake, if for nothing else, at least such kind of aggressive posturing and interpretations may be avoided. I hope what I'm conveying, my professional friends may have understood the real import, purport, and object of my this kind of suggestions, which is based on expediency also, apart from the law. The next issue which I would take, though I'll come on the aspects of the various clauses for which I have flashed questions that do you know. I'll come to that little later, but then prior to that, one more issue I'd like to raise. And that issue which was raised by me, that what may be one important defense from the levy of penalty in case of the non-audit. Now, if a person may not have got his accounts audited, there may be certain reasons for it. You'll have to find out the reason, because the single most defense which is there in such cases is given by section 273B. Now, which says that if you are able to establish a reasonable cause because of which this default has been committed, then the penalty shall not be imposed. That is what the import and purport of section 273 capital B. But then you as an SSC have to lead evidence in support of the existence of the reasonable cause. So one reasonable cause of you not getting your accounts audited was your over reliance or reliance on the guidance note issued by the institute and ignoring the impact and import of section 145 capital A. In that situation, you being chartered accountant are expected to follow the guidance note issued by the Institute Chartered Accountants of India. And if the guidance note says that because you are following exclusive method of accounting in the terms of account in terms of tax duty or cess, then you need not include them in the amount of turnover. And because of that interpretation you having taken, you did not choose to get your you chose not to get your accounts audited, then bona fide belief can be a reasonable cause, a belief which you held in a bona fide manner that may constitute reasonable cause. So, depending upon the facts and circumstances of each case, if you can make out a case based on your belief, that belief is not a fantastic belief but can be said to be a reasonable belief entertained by a person of an ordinary prudence, then in that situation, that belief may well constitute a reasonable belief, a reasonable cause, bona fide belief, and that can act as a defense against the imposition of penalty. That is a different matter. The assessing officer may or may not accept it. If he accepts, well and good. If he doesn't accept, then you can plead it before the higher appellate authority, whether it's the first appellate authority or before the second appellate authority. Now, having spoken on all these seven aspects, which I flashed by way of seven independent issues, now I'll take whether do you know that the following may not be required in law to be reported in certain situations. Though if we read Form 3CD, on the face of it, it will make a reading as if there is no respite, there is no relief, there is no leeway, there is no latitude, there is no way for an auditor not to report. Like there is one clause whereby a tax auditor is required to report the amount of interest which is allowable under section 36(1)(3) or the amount which is not, or amount of interest which is disallowable under section 36(1)(3). And in fact, section 36 subsection 1 clause 3 speaks of the allowance of interest. And so any interest which is over and above that interest which is to be allowed in terms of the provision of section 36(1)(3) obviously is the amount which is to be disallowed. Therefore, as the tax auditor, I am required to report the amount of interest paid by an assessee claimed as an expenditure against the business or professional income which cannot be allowed as a deduction. That is what one of the clauses of the tax audit report asks me as the tax auditors to do. And in that context, I made an issue that interest on borrowed capital used for non-business purpose, whether and in what circumstances, may not be reported in the tax audit. If we read section 36(1)(3), it says interest paid on the borrowed funds used for the purpose of business, it is deductible. It is an allowable deduction. Converse, that interest which has been paid on borrowed funds and such borrowed funds have not been used for the purpose of business, obviously now is liable to be disallowed. Therefore, as a tax auditor, if you can find or if you are impressed upon by your client for whom you are doing audit with the help of the evidences, either this interest though has been paid is on such borrowed funds which have been used for the purpose of business, then in that situation you need not to report anything. So if your client establishes, sir, here is the borrowed fund, this borrowed fund on one-to-one nexus basis has gone into the business, say for buying raw material, and later on if I have received the money from the debtors and if that money I have diverted for the non-business purpose, then since that money which I have diverted for non-business purpose cannot be said to be amount borrowed, and therefore no interest can be disallowed on this premise that if you have not diverted that amount for the non-business purpose, and in case or if you had brought back that amount into your business against the borrowed fund, then your liability of interest would have been lesser by that amount. No, the courts have said that this kind of an argument is not permissible in law. As to how the business is to be done, should be left to the business wisdom of the businessman. And that adage which we used to hear, that it is not permissible for the tax officer to tell and dictate to a businessman as to how the business is to be done. I borrowed, I used them in business. I got my money back from my customers in whatever manner I want to use it. The law does not oblige me to reduce my borrowing. There are plethoras of number of judicial decisions to this effect. So if as a tax auditor, you find based upon evidence that the amount which was borrowed from the bank was used for the purpose of business on one-to-one nexus basis, and thereafter if the customers have paid me my money on account of the sale proceeds of my product, and thereafter if I have used my own money which has been so received for non-business purpose, then also my claim in respect of interest on the borrowed fund cannot be curtailed, and you as the tax auditors are not required to report it, because the law does not contemplate any disallowance on this account. And therefore if later on the tax authorities ask you, or for that matter any other authority asks you, you should be in a position to substantiate your stand with the help of those judicial decisions. Suppose your auditee, your concern for whom you are doing audit is maintaining the OD account, overdraft account, or the cash credits account. And those cash credits account by its very nature are the overdrawn accounts, are in the nature of loan accounts. Therefore, even if and therefore any amount paid out of those overdraft or CC account, the department tends to take, oh, this amount which you have paid out of your CC account, OD account is the borrowed amount and interest referable to this. If it has been used for non-business purpose, I will disallow it. But the courts have said that if you have CC account or OD account, then it is a mixed bag. It is a mixed bag of funds in which consists even your own funds represented by the sale proceeds received from the debtors. And therefore, there is no such presumption under the law. The courts have said a number of decisions. 134 ITR 219 is first Calcutta High Court. 134 ITR 219. So there is no presumption that the amount paid out of your cash credits or OD account in which you deposit the checks received from your customers, or the cash collections or the collections coming from the customers stand deposited, then in that situation that kitty becomes the mixed bag, and therefore there is no presumption that the check which is issued out of CC or OD account is out of the borrowed funds and is not out of your own funds. The lawyer said there is no such presumption. There are, say, substantial amount of profits, more than the amount which an assessing officer can allege that the borrowed funds have been used elsewhere for non-business purpose. Then also, because all these arguments which I am raising ultimately now would have to be fielded during the course of assessment. And since in the course of assessment these arguments are bound to succeed, may not be before assessing officer but before appellate authorities. So if by taking this kind of interpretation which is supported by the judicial decisions, if I as the tax auditors choose not to report because there is no amount which can be said to be disallowable, then I do not commit any misconduct. But then for that, and you may not even report in your tax audit on what basis you are saying that it is not disallowable. But then you must keep the working, you must keep all those judicial decisions, you must keep all working papers in support of your this stand that it has not to be reported in your file, so that tomorrow if you are called upon, you can very well justify it before whomsoever you are called upon to justify, whether anybody, because your stand. That is why I always say that wherever the wherever the discretions are to be exercised by the tax auditor. Now, which are the places where the discretions have to be exercised? Where the tax auditor has to compute the disallowance or the additions to be made in the tax audit report. And if while reporting such disallowances and the additions, if there are judicial decisions which support a particular view in favor of the taxpayer, and if the tax auditor following that methodology, that mode, that manner, that reliance on that decision, and thereby the exercise of discretion by the tax auditors cannot be said to be suffering from the vice of any arbitrariness. After all, how can it be said to be based on some arbitrariness when there are court's decision in support of this proposition, and based upon this proposition, if no disallowance comes, then your discretion cannot be said to be suffering from the vice of any arbitrariness. The next issue is regarding section 43B. There is a clause whereby you are required to report the amount which are liable to be disallowed under section 43B, any tax, duty or cess. Debited to the profit and loss account. Now, if you have not debited to the profit and loss account, though I am conscious there are judicial decisions to this effect, that even if you have not credited these tax, duty or cess, then also it will be treated to be part of your trading receipts. For that, excise duty, now GST, in certain situations service tax. But then I am equally conscious of not one, two, several decisions, including the decisions of the High Court, which say that for the purpose of section 43B, a tax, duty or cess, if not debited in the profit and loss account. Here I am suggesting for an aggressive posturing and aggressive interpretation. But this aggressive posturing and aggressive interpretation is based on judicial decisions. And therefore, if those decisions say that section 43B would not be applicable because section 43B says a deduction which is otherwise allowable. So when you are not claiming in your profit and loss account any tax, duty or cess as a deduction, so where is the question of somebody saying that this deduction which is otherwise allowable has been debited? So the courts have said in good number of cases that in such a situation even 43B may not be applicable. So the tax, duty or cess which has not been debited to your profit loss account cannot be said that you have tried to claim any deduction, and therefore since there was no claim for deduction on account of this tax, duty or cess, therefore there was no question of applying section 43B. And if there are judicial decisions, not one, two, but several judicial decisions, and based upon those judicial decisions, if a tax auditor chooses not to report, and tomorrow if he is called upon to justify this stand, and then if he supports his stand with the help of plethoras of judicial decisions in his support, then no professional misconduct can be attributed to him. Cash payments against expenditure. Now, tax auditors are required to report the amount disallowable under section 40A3 and 40A3A. You have to compute disallowance. You have to compute disallowance. Now, you find cash payments having been made from the cash book, and these cash payments are in respect of an expenditure, the aggregate of which exceeding with 10,000 has been made to a person in a day. This is the simplest thing. This is simplest to report in case one chooses to report. But then, if tax auditor is conscious about these decisions, which say that the objective of section 40A3 was not to disallow the legitimate business expenditure, but was to disallow the expenditure the verification of which could not be made because rule 6, because the CBDT circular 6P dated 6 July 1968 said so when this 40A3 was introduced and brought on the statute. And therefore those courts decision, not in one, in good number of decisions including the High Court, that despite the removal of clause J from rule 6DD, if the identity of payee is established and the genuineness of the payment is established, then even if payment has been made exceeding with 10,000 in cash to a person in a day, the disallowance under section 40A3 is not liable to be made. So if tomorrow you are called upon either by the assessing office or by some other authority that despite the cash payments having been made exceeding rupees 10,000 to a person in a day, which was so vivid and clear in front of your eyes, and yet you chose not to report, justify your stand. Then in that situation, now you can impress those decisions in your support, and then you can make out a case, sir, based upon these judicial decisions, I have taken this stand. Therefore, the discretion which was vested in me as the tax auditor in working out the disallowance cannot be said to be an arbitrary exercise of discretion. It was based on these judicial decisions. Harshila Choradia, 298 ITR, Rajasthan High Court. Anupam, Gujarat High Court, Anupam Tele, Nirmal Kumar Saha, Manoranjan Saha, Calcutta benches of the tribe, a good number of decisions. You'll have to work hard. But then, if you can tend to take this view based on judicial decisions, then you cannot be found wanting on the professional front, or for that matter on any other front, because your reporting cannot be said to be not in accordance with law. Cannot be said to be not in accordance with law. After all, the law is not only what is contained in this Income Tax Act, but the law is not only what is contained in the Income Tax Act, but then also what is understood and interpreted by the courts. The courts interpret, having regard sometimes to the language and expressions used in the statute, sometimes having regard to the purport and object of the provision with which it has been enacted. So there are various facets, various approaches, various golden rules of interpretation of the statutes, which the courts do take into account. Had the language of the statute been so clear, explicit, and vivid, then there would have been no necessity for the courts to interpret. The necessity of courts interpreting the law comes because language is an imperfect expression, it is an imperfect medium of expression. Had everything been so clear from the plain reading of law, then the necessity of the court would have been dispensed with. There was no need for the court then to have existed. The next issue, that personal expenses. If as the tax auditors you report, I am not saying even for a moment that you have to report something contrary to law. Rather, my suggestion is that we have to report in accordance with law. But then, whatever we report, the assessment will move thenceforward, henceforward. So, if anything of the disallowable character you have reported, you take it. Either it will come by way of prima facie adjustments from the CPC, or when the case will be taken up in assessment, then it will be made by the assessing officer. And now by the invisible assessing officer, faceless assessing officer. Personal expenses. But if there can be no personal expense in case of a company, that may be personal expense of a director. And company and directors are two separate, independent, and distinct entities. So if the directors may have misused the facility of a company, that may be treated as perquisite in the hands of the director. But company, being an artificial juridical person, cannot be said to be have incurred any personal expense. And therefore, in case of a company, that is what Gujarat High Court had said in 253 ITR 749, that there can be no personal expense in case of a company. But then, if in case of a company, we as the tax auditors happen to report 1/6 or 1/8 on our own by exercising some kind of an extra perceptionary judgment, then you take it that disallowance is inevitable. But then, if on this premise, on this ground, on the basis of this judicial decision, not only this judicial decisions, but on the basis of whole lots of judicial decisions, if I as the tax auditor can take a view that company being an artificial juridical person and therefore there can be no personal expense and therefore I need not to report, my thesis stand as the tax auditor is not in the air, is not in the vacuum. It is based on the cogent reasonings by the legitimate courts. Therefore, if as a tax auditor I choose not to report any personal expense in case of a company for the reason that there can be no personal expense in case of a company SSC for whom I am doing audit, then nobody can dare to raise his finger upon me on my professional competence. As a tax auditor, I am required under the law in that form number 3CD, by virtue of one of the clauses of that form 3CD, as to what is the amount disallowable under section 40A IA. And those expenditures which I am claiming against my business or professional income, on which I was required to have deducted tax at source under chapter 17B, I having not deducted, or having deducted partially, or having not paid to the government treasury on or before the due date of filing of return. Section 40 IA says that the 30% of such expenditure is required to be disallowed, and as a tax auditor you have to compute disallowance and then you have to mention it in the tax audit. So the reporting of such disallowance is very plain and simple, and had it been so, I would not have been speaking. But then if as the tax auditor you find that the tax, though was deductible under section 194J at the rate of say 10%, whatever percentage is there, But this SSE having deducted under section 194C at the rate of 2%, and thereby there is a shortfall of 8%, and therefore that expenditure ought to be disallowed in that proportion. But then if you are aware that there is a Calcutta High Court decision in SK Tikriwal which says that 40IA disallowance is applicable in case of the absolute failure to deduct. So if your SSE took a view that instead of 194J, because the line is very thin at times, he chose to deduct under section 194C, it is a case of a partial deduction, maybe under a different section. Somebody can say, sir, having not deducted the tax under section 194J, it is an absolute failure. No. The very fact on that very amount, 2% was applied as the TDS rate, it was a case of a partial deduction. And the moment there is a partial deduction, Calcutta High Court in Tikriwal's case says that disallowance under section 40A IA cannot be made. Or if there was an absolute failure of the deduction of tax at source, and if your SSE, your client, your auditee, or that concern for whom you are doing audit, now brings a certificate in terms of the income tax rules from the chartered accountant, certifying the fact that this amount has been included in the total income of the deductee, and he has filed its return and has paid taxes on it, and that certificate now is given to you, then you need not to make any disallowance under section 40 IA. And even if there was a failure on the part of your SSE to have deducted tax at source, I mean, you are not required to report. Though the non-deduction may have got other implications for that, for your SSE in terms of section 271 capital C for non-deduction of tax at source, or for partial deduction of tax at source. But certainly for the purpose of section 40 AIA, you are not required to report it. You are not required to report it. And if you as a tax auditor have chosen to take this principlistic stand, principlistic because this principle is based on the legal principles as explained by the courts, then in that situation, if you do not report, because there was in fact no amount which could be disallowed under section 40 IA, no fault can be found at your door, no blame can be fastened at your door. As the tax auditors, your professional obligations and the reporting obligations, they converge with each other. They are not at variance. They are not in conflict. Disallowance under section 14 capital A. Now the dividend has been taxable in the hands of the shareholder, but prior to that, section 14A for most of the times used to be attracted and invoked for making disallowance in case of investment made by your auditee in the capital of some other company, on the ground that had the dividend been declared by that company, that investee company, then in that situation the dividend would have been exempt, and therefore the expenditure claimed by you in your profit and loss account against your business profits also consists some part of expenditure which has been incurred or which can be said to be incurred in relation to that exempt income. Assessing officers were hell-bent on making such kind of disallowances in the past. You must have seen. And then rule 68D on that. But then if the courts have taken this view that despite the language of section 14A couched in whatever manner, the interpretation is that the existence of a tax-free income is a sine qua non for invoking section 14 capital A, irrespective of the amount of investment made by your auditee in anybody's capital. And in that situation, by relying upon those decisions, you as the tax auditor choose not to report anything under this clause of the disallowance under section 14 capital A, and tomorrow if somebody tries to haul you up on account of any possible negligence, latch, omission or commission, then you can always retort, repel with vehemence that you cannot find for, you cannot raise, you cannot be allowed to raise your finger towards me, because these are the judicial decisions which say that unless there is actual receipt of exempt income, disallowance under section 14 capital A cannot be made, much less even by invoking rule 8D. So your this stand of not reporting anything or nil reporting anything in these facts and circumstances is secured by several judicial decisions. Or even if in certain situations even the exempt income results, then the disallowance has to be made in terms of rule 8D. Rule 8D says the average investment. Now which investment? The department would tend to take the entire amount of investment, but then the courts have interpreted, High Court, Tribunal have interpreted that only those investments should be taken which has yielded tax-free income, not the amount of those investments which could have yielded income. No, the courts have said only that much investment has to be taken for the purpose of computing average investment which has actually yielded tax-free income, and those investments which has not yielded tax-free income has to be ignored. And the moment you ignore, your amount of disallowance, if at all it is to be there under rule 8D, that comes in a very small amount. So if as the tax auditor you, having followed this dictum laid down by the judicial decision, tend to take this kind of an interpretation, then this interpretation being plausible interpretation sanctioned on the basis of the judicial backup, no fault can be found. Excess consideration under section 56(2)(7) small b. 56 subsection 2 clause small b. It is still there. 56 to 7a, 56 to 7. Now all have been merged into 56 to 10. But section 56 subsection 2 clause Roman small b, it is there. It is applicable in case of a company in which public is not substantially interested. And the section says that any consideration received by such company in respect of the issue of its shares which exceeds the face value and which is in excess of the fair market value of the shares, now that will be treated as income of that company. So that consideration which this company happens to receive on issue of its share should be in excess of two things. It should be in excess of the face value of share, and it should be in excess of the fair market value of the share. So if, but then I was reading the clause in the form 3CD. That clause in form number 3CD is at variance with the section 56 to 7b. In section, as I said, that the consideration received on issue of share should be in excess of two things: face value and fair market value of share. Whereas the clause in form number 3CD uses only one thing, that it should be in excess of fair market value. Face value has been made to disappear in the clause in form number 3CD. So if the face value is say 50 rupees, the consideration received is not in excess of 50 rupees, maybe in excess of the fair market value. Or for that matter, if I make it like 100 rupees, face value is 100 rupees, fair market value say for 80 rupees, and if the consideration received on the issue of share is not in excess of 100 rupees, that's face value. Now, whether the share can be issued at lesser than the face value or not, that may be an issue which may fall, but I am speaking in terms of the taxation laws. Then there is no concept of any income under section 56 to 7b, because it has to be in excess of the face value. Only then income under section 56 to 7b would come. Now, one issue which I framed, that do you know that not all repayment of loan or deposit in case of the company assets are required to be reported, even if made in cash. I got lots of calls from professional friends. When they read these issues, that do you know this, do you know this, then they said, how is that? And I humbly, with utmost humility, I told them that since I myself do not do audits, therefore I cannot speak. I'm not competent either to speak on the tax audit in that conventional manner. I'll speak and I have approached the concept of tax audit from a different angle as to how to achieve convergence, reconciliation between the reporting obligations under the law and your professional obligations to report correct and in complete manner. Because I always say that the reporting requirements under the tax audit are of two types. One is whereby we as a tax auditors are required to report on facts. We have not to express our opinion. We have not to compute any disallowance. We have not to exercise any discretion. And since we are required to report facts, the facts as they are. Facts have to be only one fact. There cannot be two facts on one aspect. Therefore, when as the tax auditor I am required under the law to state the facts, then I don't have any choice. I don't have any discretion. I like to report the facts as they are. And we chartered accountants are considered as the master of facts. And therefore, there is no scope, there is no room, there is no leverage of any sense of any nature whatsoever in the matter of reporting of facts. The facts have to be reported as they are. So, when I say that, do you know that repayment of loan or deposit in case of a company SSE, even if paid in cash of any amount, may not require to be reported in all cases. Therefore, our curious mind asks as to which can be those instances whereby such ostensibly and patently and brazenly looking violation of law is there, and yet as the tax auditors I am not required to report. If I am saying that at least we'll have to concede to this extent to my wisdom, whatever little I do have, that I may be having something to ponder, discuss, and deliberate upon. So for that, we will have to go first of all, the genesis of the section. Section 270 or 269T for the repayment, because I'm talking about repayment. I have not said about the acceptance of loan or deposit. I have said about the repayment of loan or deposit under section 269T. There are whole lots of clauses. I was reading form number 3CD, maybe for the purpose of speaking before you, not for the purpose of doing any audit, because I do not do audit anymore for last almost 20-25 years. So 269T, now what does it say? That no person, it starts with a negative covenant. That shows the emphasis which the legislature wants to place to that prohibition, that no person shall repay any loan or deposit otherwise than by an account pay check or bank draft or through electronic clearing system if the amount of loan or deposit at the time of repayment is rupees 20,000 or more. Loan or deposit. It should be loan or deposit. Somebody can say, sir, any loan or deposit for that matter is a loan or deposit. And therefore, if that loan or deposit on the day of repayment was rupees 20,000 rupees or rupees or 20,000 rupees or more, then even a single rupees payment ought to have been made through the banking channel. That is what the purpose, that is what the object, that is what the mandate of section 269T. Very right, very right. But then let us see the meaning of the word loan or deposit for the purpose of section 269T. Not for the purpose of section 269SS. For the purpose of section 269SS, the meaning of the word loan or deposit is loan or deposit of money. Whereas in case of company SSE, in the matter of repayment, loan or deposit means, it has been given in the explanation at the end of the section. Loan or deposit of money which is repayable after notice. Kindly mind the expressions. Loan or deposit which is repayable after a notice or repayable after a period. So if it is not a demand loan or deposit, sorry, if it is a loan or deposit which is repayable after notice or which is repayable after a period. So if there is a third category of loan or deposit, third category means the category which does not fall either in this category which is repayable after notice or repayable after a period, then there is a third category. So which is repayable on demand, that can be the third category. In that situation you can say it is not repayable after notice, it is not repayable after a period, and therefore this is the third category, that it is repayable on demand. There will be no notice which will be given. There is no time limit prescribed for the repayment of the loan or deposit, and therefore it falls into the third category of the loan or deposit in the case of a company, and therefore such a loan or deposits repayment would not be hit by section 269T. Some of my friends who are acting as the tax auditors and then who are acting as the authorized representative before the various tax authorities, once upon a time they said, Rakesh ji, even if as the tax auditors we may not be as liberal in construing our professional obligations, meaning thereby that we will go in for by a theory of conservatism in the matter of our reporting obligations and may not go in terms of what we are speaking, that is their choice, of course. But one thing which is coming out from your this deliberation is that since we are acting as the tax consultants also for our clients, now all these things which we have just shared in respect of various clauses, ultimately the additions and the disallowances are made by the assessing officers in respect of these kind of sections which we have just deliberated. At least our eyes are wide open on all these aspects of all those sections. We, when at least while representing our cases before the various tax authorities, now we would take them into account. So far so good. So far so good. Now if in whatever manner a person practicing as a chartered accountant, can capitalize on all these issues, because it is not in fact a capitalization, because after all this is not something which I have invented. This is not something as if I am asking you to follow it because I am saying no, because this is what the position of law as understood by the courts, not in one but in good number of judicial decisions. And therefore these interpretations are not just in the air, they are not in vacuum. So the repayment of loan or deposit in case of a company, if that repayment is not in respect of the repayment of such loan or deposit which is repayable after a notice or repayable after a period, then in that situation, even if that payment is made or repayment is made otherwise then by an account pay check, since that loan or deposit does not come within the definition of loan or deposit under section 269T, and therefore such violation is not captured under section 269T, and therefore if in that context we are not required to report, or if we do not report, then no blame can be fastened, because loan or deposit is referred under section 269T. That is the expression which has been used in form number 3C. The next issue, as the tax auditor, under one of the clauses, you are required to report that because of the operation of section 79 of the Income Tax Act, in case of a closely held company, because of change in shareholding by more than 51%, as on the last day of that previous year in which the loss was incurred, and the last day of this previous year in which that loss is sought to be adjusted, is sought to be set off. Section 79 says that more than 51% shareholding should remain in the same hands as on the last day of these two previous years. जिस साल में लॉस हुआ उस साल के प्रीवियस ईयर के एंड में, और जिस साल आप सेट ऑफ करना चाहते हैं उस साल के 31st March, that is the last day of the previous year, the shareholding more than 51% must remain in the hands of the same shareholders. There may be inter se change, but those 51% shareholders or the shareholders holding 51% shareholding must be the same. किसी के 10 थे उसके 1 हो गए, जिसके 1 थे उसके 10 हो गए, but these shareholders holding 51% shareholding must be same. Only then the benefit of that loss which was incurred in that year can be claimed and set off in this year. But if we read very closely, that says that the loss under this chapter means the chapter in which section 79 comes, meaning thereby that unabsorbed depreciation does not come into that chapter. Brought forward business losses, other losses, they come in this chapter. in which section 79 is placed. But unabsorbed depreciation, brought forward depreciation of any year, including that year which we are talking about, does not fall into the chapter in which section 79 is placed, and therefore unabsorbed depreciation is outside the ken of section 79, meaning thereby that even if there is even 100% change in the shareholding of a closely held company, the benefit of the brought forward depreciation now cannot be denied in subsequent year, even if there is 100% change in the shareholding, because section 79 divides the carry forward and set off of the losses under that chapter, and unabsorbed depreciation does not come under that chapter. There are so many other clauses also, but if there are questions, then first of all I will like to take the questions, and because after all the benefit of these deliberations is there when there are questions from the audience, and those questions are replied to the extent, if not fully, to the extent or to the extent of the satisfaction of that person who is raising this question. This 1.5 hours I have been speaking, and if there are questions, then I would tend to reply them first of all before I take up some more clauses if the time permits. So, Deepak, if there are questions, kindly let me know. Yeah,
Yes, sir, there are questions, and
yeah.
now I am asking these questions. And
Hmm.
thank you very much for continuously speaking since last 1.5 hour. So now let's start taking questions, friends. Those who have queries, you can ask your queries in the chat box. In the meantime, I'm starting queries, and once again, thank you, sir, for having an excellent deliberation. I request all the participants to like this video and share this video with your colleagues and other friends as well, so that this video can reach to the maximum participants.
Yes,
So first question is from the Rupin merchant.
मैं
Where
पढ़ता हूँ
total?
तुम्हें
Yes.
क्वेश्चन। अरे
Okay,
तुम
sir.
क्वेश्चन देते रहो, मैं पढ़ लूंगा।
ठीक है,
So
ठीक है.
रुपिन भाई पूछ रहे हैं, where total income
Hmm.
after deduction is below taxable income, still it is required to books of accounts audited if profit is less than 6% or 8%. No. If you read section 44 AD subsection 5, then there are a couple of conditions. The first condition is that you should be hit by subsection 4. Number one. Number two, your total income. Total income means the total income after the deductions under chapter 6A. So the total income is above the threshold limit. Like I'll read section 44 AB clause E first of all, which asks me for the audit. 44 AB clause E, it says that a person carrying on business shall, if the provisions of subsection 4 of section 44 AD are applicable, and his income exceeds the maximum amount which is not chargeable to income tax in any previous year, has to get his accounts audited. तो सबसेक्शन 4 और सेक्शन 44 एडी कहां अट्रैक्ट होगा रुपिन जी? If you remember that where in any of, if in any year you have availed the benefit of 4481, then in any of the succeeding 5 years you though declared profit but not in accordance with subsection or section 44AD, then in that situation then you are hit by subsection 4, and therefore subsection 4 is applicable in your case. So if subsection 4 is applicable and if your total income is above the threshold limit, then you have to not only to maintain books of account, but then you have to get them audited also. Next, please. How to consider value of shares where shares are stock in trade? it can calculate as per cost price or as per ICDS. Is it compulsory to consider as per देखिए, income computation and disclosure standards are the notified standards in terms of section 145 capital A, and therefore now these income computation and disclosure standards have got the statutory force, and therefore they have to be followed. If you remember, prior to 2017, many ICDS were not given statutory recognition, and therefore when the very validity of these income computation disclosure standards now were challenged before the Delhi High Court, now the bench, which are presided by none other than by my lord Dr. Justice Muralidhar, now that bench said that these ICDS did not have statutory recognition, so therefore they cannot be enforced as a matter of law, and thereafter the government came out with adequate necessary modifications and amendments under the act by which ICDS have been made mandatory, and therefore if ICDS says something to be done in a particular manner, that is the mandate of law that has to be followed. Next, please. Divya Kumbnani. Respected sir, this is for a salaried employee. He has made a F&O loss of 8,89,982 on a derivative turnover of 1 crore 82 lakh. Tax audit is not required because Divya ji, the institute's guidance note coupled with judicial decisions say that in case of the future and options, the aggregate of the profits and the aggregate losses on all settlement dates in respect of all transactions put together would constitute turnover, and in your case it is less than a crore of rupees. Therefore you are not required, even if your derivative turnover may be in excess of 1 crore of rupees, but then F&O loss that will constitute turnover, that you are not required to get your accounts audited. But in case of the salaried employee, if you are a government employee, whether you could have done future and options, that itself is a question, because to carry on future and options is considered as carrying on business. Yes, Arun Mittal ji. I also repeat Mr. G. Gopal Krishnan query. So I have not seen Mr. Gopal Krishnan's query so far. Okay. Ganesh Gopal Krishnan's query is whether a person carrying on real estate business and during the previous year whose turnover is less than 2 crore can opt for 44 ADS. Yes, Gopal Krishnan sir, if you read explanation small b to section 44 AD, which is appended at the last of section 44 AD, which seeks to explain the eligible turnover, then it makes only one exception. It says that a business which is not a business of plying, leasing, or hiring goods carriages as referred in section 44 AE. Then under subsection 6 of section 44 AD also certain persons carrying on certain professions and business, they are excluded. So therefore this real estate business can be an eligible business if its turnover is less than 2 crore for the purpose of section 44 AD. तो गोपाल कृष्ण सर का क्वेरी तो ये पूरा हुआ नहीं, एक वो दिखलाओ जो जिन्होंने लिखा था ना कि मेरा क्वेरी गोपाल कृष्ण साहब की तरह है, अरुण मित्तल सर. I also repeat Mr. Gopal Krishna's query as to if a person carrying on real estate business and during the previous year whose turnover is less than 2 crore. Yes, your query is the same, my answer is same. Arunji, yes. Praveen Sahu कह रहे हैं, if an accountant has shown TDS deduction entry of first quarter into second quarter TDS return and has not filed Q1 TDS return, what would be the reporting requirement if an accountant has shown TDS deduction entry of first quarter into second quarter? Praveen Sahuji, now as to how the matter is to be reported, I think I may not be a competent person. Now I am a person who deals in law day in and day out, and therefore I could have told you as to what can be the implications in the law, but then how to present it in form number 3CD, probably. I mean, I'm so sorry. I'm not in a position to guide you in that regard. Kulvinder Singh, in partnership firm whose first year turnover is less than 25 lakhs and have loss. required to audit under section 44AD being no. Kulvinder Singh sir, if you remember, and I hope and believe that you were there when I was dealing this aspect. 44AD, if has not been availed by you in the past, it cannot be thrust. It cannot be thrust upon you. Now, if you have chosen to have returned your income in any year under section 44AD, then to follow 44AD in succeeding 5 years is mandatory. So if it was your first year, even if your turnover may be within the limit of 2 crores, even if your business may be the eligible business, even if you may be an eligible SSE, 4480 will not be thrust on you. Amit Kakkar, sir, in a preceding previous year, I was liable to tax audit as my turnover exceeded the maximum limit. Since my previous year turnover is less than 1 crore and profit is more than 8%, can I opt to 44AD? Yes. Now, if your turnover is less than 1 crore of rupees, profit is more than 8%, then you can go in for 44AD. Now, irrespective of the fact whether in preceding previous year you are liable to tax audit as your turnover may have exceeded the maximum threshold of that section, irrespective of that, you can go in for 44AD. Yes. Next, please. Ritu Mahajan. Where total income after deduction is above taxable income and turnover below 1 crore, still is required books of account get audited? No, I said unless you are hit by subsection 4 of section 44AD, you are not required to be hit by section 44AD unless you are hit by 44AD4. So in such a situation, I am presuming that you have never availed 44AD in any of the earlier years, and therefore you are not required to get your accounts audited even if your profit is even less than 6 or 8%. I will go to this extent. Okay. Yes. Vipulji, as a partner of a professional CA firm, can we be covered under section 44AD in respect of partners remuneration and claim X? Yes. You can, Vipulji, you can. Because professional remuneration is your professional income. राजेश भल्ला जी, सर जी, हाउ डू यू, ये मैं प्रश्न भूल गया, मैं इसका उत्तर देना, क्योंकि मेरे मित्र पंकज अग्रवाल जी लखनऊ से, उन्होंने भी आज सुबह मुझसे प्रश्न कहा और भी बहुत सारे लोग इस प्रश्न को करते हैं. राजेश जी, आपने बड़ा अच्छा मुझे याद दिलाया. हाउ डू यू इंटरप्रेट द वर्ड्स ए सम हायर देन एज द केस मे बी सेक्शन 44AD, that is scope of AO in section 44AD assessment vis-a-vis section 68-69? Very good question. देखिए, when 44AD or 44ADA for that matter says that you have to show 8% or such higher amount as may be claimed by you, or 44ADA says 50% or such higher amount as may be claimed by you, that means that if you show more than these amounts or whatever amount, only to that extent you can be said to have accrued or benefit of accrual in your assets. Now it cannot be that you return 8% of the gross receipts as your income, but when it comes to the creation of assets, you create assets equal or more than at 8%. No, because section 44AD or 44ADA are notwithstanding to section 28 to 43C. They are not notwithstanding to section 68 to 69. Therefore, even in such a situation when your income is assessed under section 44AD and 44ADA, if there are abnormal deposits in your bank account, or if there are abnormal amount of your business stocks, now you cannot be heard saying, you cannot be allowed to shrug off your head, oh, since you are not required under the law to maintain books of account and therefore nothing should be asked from you. No, there can be no such law. In such a situation, if there are deposits in your bank account which are within the limits of your turnover, then one can understand. But then if there are deposits which goes far beyond the amount of your turnover, then the burden is on you to prove it. There is no blanket license given by the framers of law that you follow 44 AD and 44 ADA and then you create any amount of assets. No, it is not permissible. So if you want to say in case of a professional that you have got 80% income, then to the extent of 80% of income, your assets can accrue. I remember I gave this example because I had an occasion to argue his case. He was from Srinagar, Garhwal, Srinagar. There was a survey. He was carrying on the business of cloths. He was returning his income under section 44 AF at that time, which is in perimeter at 44 AD. And in survey, the stocks were found at a very mammoth figure in the godown when the stock taking. And when he was asked, he said he had been returning his income since last 10 years on the basis of presumptive scheme of tax under section 44 AF. Therefore, I am not required to explain the availability of stock with me. No, that kind of an argument now is not available. You will have to justify the availability of a stock in the light of the income which you have disclosed, maybe under the presumptive scheme of taxation. Therefore, Rajesh ji, 68 and 69 still have to play its important role, and an SSE following 44 AD cannot wish them away. I would say this much. Next, please. Umeed Kuntal sir. What if a closely held private company has issued shares at a face value while the company has accumulated profits? How to report it, or is there any remedy to rectify it? No, I have not been able to follow. What if a closely held private company has issued shares at face value? Yes, it can issue at face value. While the company has accumulated profits, let the company may have accumulated profit. How to report it? No, there is nothing unusual for you to report in the background of these facts. Had this company issued shares at more than the face value and the fair market value of the share, then in that situation you are required under form 3CD to have reported the amount of income in terms of section 56 clause 2 subclause small roman 7b. In such a situation, Umerji, I have not been able to appreciate, comprehend, fathom, understand as to why, I mean, you as a tax auditor are required to report this phenomena. No. Next, please. Nehal. If client is in clearing and forwarding business and he puts reimbursements amounts also in sales invoices, and due to that his turnover is more than 2 crore, then he had to go for tax audit. No, he had to go for tax audit even if his turnover had exceeded 1 crore. In the facts and circumstances of your case, probably you mean to say that you were availing 44 AD and that is why you are saying that you have crossed that limit of the eligible business of 2 crore. So if he puts a reimbursement amount also in sales invoices, so that will be part of your turnover, because the word which has been used is the turnover. So if you make them as part of your invoices, then there may be a problem. And I think on the guidance note, the guidance has been given by the institute that in such a situation, the reimbursement whether should be part of the turnover or not. According to me, it should be part of the turnover. Next, please. Prakash Kochar sir, firm case. As per P&L, deduction under section 40, income more than 8%. As per P&L, deduction under section 40. Before deduction under section 40, 40 means 40 small b, 40 small a, 40 small ai, 40 aia, 40 capital A. I mean, nothing is clear, but then probably you mean to say 40 small b. Income is more than 8%. Net after deduction under section 40b, balance income is zero. Read our audit read with section 44 AD necessary. Yes, yes. Section 40B deduction can be allowed to a firm which is engaged in the business referred into section 44 AE. But in case of a firm carrying on 40 or carrying on or eligible under section 44 AD, this allowing separate deduction under section 40 small b, that is not contemplated, because if you read subsection 2 of section 44 AD, says that all deductions under section 30 to 38, and 40 small b speaks of the disallowance, not of the allowance. So that will be deemed to have been allowed, as if it has been so claimed and allowed. So if balance income is zero and you have already availed 44 AD in earlier year, then of course you are required to get yourselves audited under section 44 AD subsection 4 and 5 and 44 AB small e. But then if you have never claimed earlier 44 AD, this is your first year, say second year, then in that situation, then you are not required to, since you are not hit by 44 AD4, therefore you are not required to be covered under section 44 AD. And then there is no requirement for you to get yourselves audited unless you cross the threshold of section 44 AB itself. Next, please. Harsh Bang. If the decision of the tribunal court results in increase in turnover, will this increase be considered in current previous year for purpose of turnover calculation? देखिए हर्ष sir, the law is like this. When the courts interpret a provision of law, they do not make a law. They interpret the law as if the law was always like this. Therefore, theoretically and practically speaking, yes, turnover would include something which has been so held to be part of turnover as per the court's decision. But then if you, in case you had taken some other view, and because of which you have not got your accounts audited, and in case the penalty is imposed on you because of this default, then you can put the defense of reasonable cause that, sir, this interpretation which has been so placed by the court now was being interpreted by some other court or in some other quarters in this manner also, or was capable of being interpreted in this manner also. Therefore, the SSC entertained a bona fide belief as to the correct interpretation, and therefore this bona fide belief constitutes reasonable cause. And since it was a reasonable cause within the meaning of section 273 capital B, and therefore the penalty should not or may not be imposed. Next, please. Rajat Garg. Dear sir, whether books of accounts are mandatory to maintain under section 44 ADA if profit is shown more than 50% of professional receipts? So if you remember, Rajatji, I started my today's deliberation with this only, that if we read section 44 ADA subsection 1 and subsection 4, then if my receipts are less than 50 lakhs, I show more than 50% or more than 50% as my income, then I am not required to maintain books of account. So I am not required to maintain books of account, because according to your own question, your profit is more than 50% of professional receipts. So in this situation, you are not required to maintain books of account. But then, of course, you have to show something that you are into the profession. Number one. Number two, your gross receipts are not more than 50 lakhs. These two things you'll have to show. And for that, whatever record is essential for you to show, to maintain, that will have to be maintained. Books of accounts are not required to maintain. Next, please. Manish Joshi. Whether phantom tax, what is this phantom tax? of associate company, which is the tax paid like section 50CA on sale of investment in associate company, can be claimed by the company selling the investment as it is not its tax. No. Whatever you call it is a phantom or whatever name you want to assign this tax, this will not be allowed as a deduction. Next, please. In case of firm, interest and remuneration to partner is not allowed under section 44 AD. Then will it be allowed if not audited? No, your mode of putting the question is different. Now let me rephrase your question. Then you tell me whether it serves your, really question or not. Now you are a partnership firm and you are allying interest and remuneration in terms of section 40 small b. Your turnover of any amount, your profits of any amount, even lesser than 6 or 8%. Yes, if your turnover is more than 1 crore rupees, then you have to get yourself tax audited. Then you declare and then you claim. You are not, if not audited, then will it be allowed if not audited? No, it depends upon it. Suppose if your turnover is less than 1 crore of rupees, obviously you are not covered under tax audit. You compute income as per a books of account, claim remuneration interest under section 40 small b, and then be happy. If the department would have guts to assess it more on some cogent basis, the department will do. Otherwise, you will have your own feel. Mahesh Bhai Sahab, Saharanpur Bhai Sahab ko namaskar. In clause 27A, in form as per income tax rules, input tax credit word is not used. But in 3CD utility income tax credit is also used, which should be followed. Mahesh ji, you know my limitations. I am not a man of audit. So even I approach the concept of tax audit from the tax angle. Therefore, I may not be appropriate person for this, for replying on this question. There is no law, whatever little I know, involved in your query. Balraj Kalia sir. Professional receipts are 35 lakhs, but profit is 12 lakhs. So 35 lakhs, 50%, 7.5 lakhs. Of course, the audit is required because under section 44 ADA, subsection 4, you are required, and provided your taxable income is above the basic threshold limit, audit would be necessary. 44 AB clause small d. Yes.
So friends, sir, अभी बाकी questions नहीं है. There is no further questions left.
और 2 घंटे भी हो गए हैं आपको.
Yes,
ये
sir.
बताओ कि जो भी क्वेश्चंस आए हैं जो चैट पे हैं, ये सारी मुझे भी दे देना फॉर माय रिकॉर्ड. ठीक है ना? ठीक है.
ठीक है.
हाँ, ये मुझे दे देना.
यस, मैं देखता हूँ सर इसमें, क्योंकि इसमें से चैट निकल नहीं पा रही.
नहीं, विवेक खुराना जी वो
यूट्यूब
निकलती
से
है.
देखता हूँ चैट कैसे एक्सट्रैक्ट होती है. चलो ठीक है, फिर मैं देख लूंगा वो निकलती है तो.
ठीक है, तो
ठीक है. ठीक है सर.
तो मैं अपने दर्शकों, ऑडियंस से धन्यवाद करूं हृदय से. मैं उन सभी का हृदय से आभार व्यक्त करता हूं. यस.
Thank you very much, sir, for taking the session and so gracefully, and had very excellent session, and had very great audience. And right now also there are around 200 plus participants are listening to you. So I'm thankful to you as well, and to all the participants, those who are listening to us our today's session. My humble request to all the participants: kindly like this video and share this video so that it should reach to the maximum participants. And if you have not yet subscribed our channel, kindly subscribe the channel so that you can get all the updates of our upcoming webinars and upcoming videos or webinars that we are posting on our professional topics. So thank you very much, everyone. Thank you. Now I'm winding up the today's session.
Thank you. Thank you. Thank you.
Thank you, sir.